Now, let me introduce you to the world of alternative investments. Any investment, it has to be categorized either under the traditional investment category or under the alternative investment category. How do I differentiate these two worlds? The most traditional stock market, the bond markets, and the cash markets, which have been existing for long period of time, we put them under the traditional investments world. But anything that does not fall into these traditional markets, wherein we are talking about the kind of assets they can include, the kind of securities they typically include in each of the classes, and the way in which the structure in which they typically include the assets and the way the trading is typically done, they differ in lots and lots of mechanisms. And in short, any of that is not falling under the traditional investments is going into the alternate investment. And with respect to the traditional investment market, we see lots and lots of regulation. The stock markets are very heavily regulated. The bond markets are very heavily regulated. But with respect to the alternate investments market, the regulations are much, much lesser. That's so because of that, there are many things which a traditional investment doesn't offer, but alternate investment is offering. So when I'm looking at probably a comparison between a mutual fund which generally invests in a traditional investment market versus the alternate investment markets, we see that the derivatives can be used very widely here. Whereas with respect to the mutual funds, there is a lot of limitation or restriction in terms of the usage of derivatives for creating the positions. The leverage, there could be unlimited leverage that could very well be used in alternate investments. Whereas again, there are restrictions with respect to the same in the traditional market. There could be heavy investments done in the illiquid assets or illiquid asset generating firms. Again, restrictions can come out. Short selling is something which is quite heavily done in the alternate investment market, but again, the restrictions go in the traditional. So the alternate investment market provides a very heavy flexibility to the users in terms of investing in that particular market, right? In terms of accessing the various investment avenues, the alternate investment market is providing large number of opportunities. And traditionally, we see the real estate being considered as a part of the alternate investment market. The commodity investing typically goes as a part of the alternate investment market. We see lots and lots of private equity investments going as a part of alternate investment market. And we can also talk in terms of hedge funds, a very heavy composition of the alternate investment market. All these, they are not traditional investments. In some cases, some kind of valuables investments like art or any other valuable specific antiques kind of investments also go as a part of the alternate investment market. This is a huge market, again dominated by different asset classes and the different securities that are going into the different asset classes. And here there is a kind of a specialized knowledge, right? It's not like a traditional investment, so people are considered specialists in those particular areas. So the fee structures also are very much different from a traditional investment. We see majorly the fee structures are slightly higher, and there is a component of the performance based fee for a large number of investments. For investment fund managers, we see there is a performance based fee that is bundled into it. And another important thing that we see with respect to the alternate investments is there is not too much of a publicly traded market. So the liquidity is a major concern with respect to a good number of alternate investment. Compared to the traditional stock and bond markets, the liquidity is much lesser for them. You need a specialist to actually manage it, and even from an investor's perspective, the knowledge that is required for the investors is going to be much higher. So the number of people who are investing in these markets is comparatively lesser, and because the regulations are not much heavy, transparency also typically goes down for these kind of markets. So the investors need to be very carefully examining all the important features of each of these contracts, so that they gain confidence in terms of investing in these. And probably the past data regarding the transaction, the successes, the past data availability is always a concern, because it's not available public. It purely depends on the company publishing this data, and it may very well be biased. Different kinds of biases can very well be creeping into the data. So availability of the data, reliability of the data, accuracy of the data is always a cause of concern while investing in the alternate investments market. So even an investor needs to be very much vigilant about the legal issues, the tax issues with respect to investing in those markets. But traditionally, what has been seen is alternate investments, when I put them next to the traditional investments, the correlation of the returns with respect to the alternate investments is much lesser, which means having these alternative investments as a part of the portfolio which contains some traditional investment obviously is going to reduce the standard deviation of the overall portfolio, because we know that the standard deviation of the portfolio is going as our variance of the portfolio W1 squared sigma 1 squared W2 squared sigma 2 squared plus 2W1 W2 correlation between the two securities sigma 1 sigma 2. Now what we are saying is the correlation, if I am assuming that one is the traditional investment and two is the alternate investment, if I am combining these two, because of the correlation between the two being much lesser, this component will be very small, overall resulting in the variance of the portfolio going down, thus resulting in the standard deviation or the risk that is associated with the portfolio going down drastically. So, over long periods of time, we could clearly see that the correlations are much lesser, which means the risk is overall risk of the portfolio is going much lesser, right? So but at the same time, there is a discussion in the community that whether the standard deviation is a good measure of risk for alternate investments. Standard deviation is a much better measure provided the returns are more and more normally distributed. But if they are very fluctuating drastically, probably having something based on the historical frequency kind of an analysis, or using some kind of extreme value distributions will make a lot of sense rather than using a simple standard deviation. So that's a flop side associated with, though the overall risk is much lesser, there is some kind of an apprehension towards the investing in this kind of a market. And now when I look at the other side, the returns in the alternative investment market, traditionally they are higher. right, on an average. But of course, some kind of reasonings that they typically come out because I mean that some of the important reasons that come out is the pricing is less efficient. The efficiency does not exist in the pricing, and the liquidity is a concern. So there is a liquidity risk that is packaged into it. So to accommodate that liquidity risk, some kind of additional return needs to be provided, and even the credit risk is much higher because majority of them use heavy leverage. Because the leverage is higher, the risk is higher, so they have to provide for a higher return. So individually speaking, the risk is much higher for them. So obviously the returns need to be higher. But one thing what we have looked at is when we package them as a part of the portfolio, because of the correlations being much lesser with respect to the traditional investment, they will reduce the overall risk of the portfolio. And because of that, the overall scenario is going in such a way that the portfolio's risk in terms of standard deviation is going down. The portfolio's return in terms of the expected return is going up. What else do we need? The risk is reducing, the return is growing. Nothing else is specifically required. So, which means it looks at the outside that it is much effective investing in the alternate investments, creating a kind of a portfolio. But let's understand a few things here. These are not publicly reported, which means whatever the data that might have come out could be very much exposed to a lot of biases. And more specifically, we are talking about a survivorship bias and a backfill bias. When I talk about the survivorship, yes, right now when I look at the approximate average return, right, if I look at the average return on the data that is currently existing, obviously that return could be a much effective return because those are the firms which are currently surviving. But in this process, I might have omitted those firms which got into huge losses and they have closed down their businesses. I should include them also into the computation of average. Probably, if I am talking about firms 1, 2, 3, 4 to 10, and I'm looking at the return computation. Let's say in the last year, the firms 1 and 2 went out of the business. Only these 8 firms are remaining. Now, if I compute the returns for these 8 firms, the average return would typically be higher itself. But had I included these 2 firms also, my return would have average return would have come down by a decent extent. So generally, while doing the reporting, it is done in this way. The recent data is being collected, and the ones which failed in the past, they got omitted in terms of the computation of the average. That is what resulting in the averages always being shown on a higher optimistic side. Similarly, for those firms which are currently there, or let's say newly added, I have added a firm number 11 now. Now, for this firm number 11, so which means, let's say in the last year I had firms 1 to 10, this year I had firms 3 to 11. Now, when I omit this 1 and 2 from the computation here, obviously that is what is referring to survivorship bias. But in addition to that, okay, now that 11 got added into the data now, we will try to backfill the values of the returns of 11 to the past and compute the average. Now, the difference that brings out is I'll try to omit these two, I'll try to include this. Obviously, this firm is a successful firm, so the returns could be much better here, and it may very well look like these 1 and 2 which have performed well in the previous year. By removing them and adding this, it looks that the performance here was much lesser, but suddenly it is improving drastically. So the growth rates which we see would be much higher, and that is what we are calling as a backfill bias. Because of filling the old data, with the new list, there is always a possibility again the new looking more and more rosier compared to that of the old. So the bias always tries to push the values in the upward direction, giving a much better picture of the returns compared to the traditional investment market. So that is one place where the investors need to be cautious of, where they need to be more wary of if they have to go ahead in terms of investing in the alternate investments market. And just to understand the various types of alternative investments, we'll spend more time in terms of understanding all of them. But okay, the broad categories wise, I can look at the hedge funds. We'll talk about private equity funds. We would also be looking at real estate as a major source of alternative investment vehicle. Then we are looking at the commodity and the investments in the commodity. Of course, then we have more specialized things like art, antiques. That's a specialized area altogether. Some kind of investment in some various patents. Even these become more and more specialized kind of areas. But traditionally, these are the four instruments which form the base for the overall alternate investment market. So all those trading strategies, see, generally we see the intention of these funds is use any kind of investment mechanism. If you want to use leverage, use it. You want to do some kind of shorting, whatever are the restrictions that are there in the traditional investments, they don't hold any way for these investment managers. If you want to use derivatives, go ahead and use it. Want to invest in illiquid funds, go ahead and use them. The intention is use any kind of a strategy of your choice, generate the gains out of the investment, right? As the word is saying, hedge, they need not do any kind of a hedging. They are primarily using any kind of strategies. We'll talk about different kinds of strategies as we move forward, but any kind of strategies is something which they can very well resort to for generating the gains on the investment. And because the disclosure requirements are much lesser, they have some kind of restrictions in terms of who can be included, who are the potential investors for the hedge fund, what should be the minimum criteria for investment in a hedge fund. So some such kind of norms is what the hedge fund investors typically get into. Then we have a private equity funds where on a broader class I can look at them in terms of equity investment, right? Either non-public firms, they do invest with an equity stake, or even if they are investing in case of public firms, their intention is to make them private. They invest in a public firm with an intention to make private. Very common kind of mechanism is the leverage buyout mechanism, where they take a debt to buy out the equity stake of the companies. And there is one more category in the private equity firms which is called as a venture capital firms, where the typical amounts are invested in the new upcoming kind of companies. It could be in a right at an early stage, or even at a growth stage, or some kind of development stage. There are different stages as a part of the venture capital investment. So venture capital funds are majorly targeted towards investing in new companies, whereas the traditional private equity funds are more and more targeted towards firms which have already established for themselves. Either they are non-public, or even if they are public, they are doing well, and the intention is to take a stake and convert that public into private. In some cases, we could see these firms even invest in distressed firms also. Of course, hedge funds also do that. But yes, there could be some kind of funds which could invest in distressed companies also. So all these we would be looking at on a broader scale how we interpret each of these different forms of alternative investments. Then when I look at the real estate, yes, there could be residential or commercial investments. And in general, any investment in the real estate, I can look at it with respect to ownership, right? I can purchase a house, that's also a real estate investment. Or I can take a leveraged ownership, which is more with respect to I take a loan and then buy a house. Then I can very well get into the mortgage-backed securities, investing in the mortgage-backed securities, which are primarily the bonds whose cash flows are primarily based on the interest and the principal repayment that come out of the real estate loans. So that is also giving me an exposure to the real estate investment, and some kind of limited partnerships, equity investment in the real estate, like we can talk about real estate investment trusts, which are like equity. I can invest in a fund which in turn invests in various real estate properties, and depending on the return that they generate on the real estate properties, I would be getting my dividends, or I would be getting a capital gain, just like a share in a company. Or I could even looking at purchasing the shares of a real estate company in the stock market itself. All these things will give me some kind of exposure to the real estate market. Similarly, when I am looking at the commodity market, again trying to get an exposure to the changing commodity prices, I want to get some kind of gains if the commodity prices go up or vice versa. So some kind of an exposure is either simply buy and own the commodities. In not may not be possible in all the cases. There are various derivative securities that are based on the commodities, so I can very well get into buy or sell with respect to those commodity based derivatives. I can buy the stocks of those companies which are dealing with the commodities. So in all these cases, I can very well get an exposure to the commodities. Sometimes there are a few funds which actually track the commodity indices across the world. So investing in this particular fund which track the commodity indices by holding the derivative positions in them, which typically go with which means depending on how the commodity index is changing, even the benefit or losses for my positions also change. So there are wide varieties of alternate investments coming up, lots and lots of new innovative products with respect to these alternate investments cropping up. So a good understanding of each of them, how they differ from the traditional investments, what are the kind of cash flows that come out of them, really creates a much better investment opportunity, and also forms the base for diversifying the portfolios to a very large extent. All right. Now let's spend some time in terms of understanding the basic world of hedge funds. Hedge funds are those kind of pooled funds which are pooled by investments from various investors. In turn, they are invested in almost any kind of a possibility. They are the ones where which can be invested in almost any kind of a possible investment and any kind of position. They can take long or short positions both in the equity market or the derivative market, or for that matter any other kind of markets. Their strategies are completely different from that of the traditional investments. More and more flexibility in terms of investments comes up with the hedge fund managers. Any kind of a position can very well come up for them. So that is where we really need to understand some of the important aspects relating to the hedge funds. One important point is majority of the times the hedge fund managers who are managing the different hedge funds, they trade through the prime brokers. They trade through prime brokers because of the complex nature that is built into the hedge fund. And these prime brokers, they offer, along with the trading, they provide even custodial services. They provide different kinds of administrative services. They even do the money lending service for buying the various securities. So they offer different kinds of loans. They even provide the securities. They even lend the securities so that they can be shorted. All these things can be provided by the prime brokers, and the hedge fund managers can negotiate different kinds of service contracts with them in order to engage and execute all these different kinds of trades. Right? Then, coming to the next important aspect, the return. The way the hedge fund returns are typically talked of is either on an absolute scale, talking about let's say 15% return, or it could be on a relative scale, saying 5% more than the index, more than the stock market index. So, some kind of a benchmark, and we are talking about some percentage more above the benchmark, some comparison with respect to the benchmark. And what is very much required to be known is the regulations are much lesser with respect to the hedge funds. And from a legal setup perspective, the hedge funds are set up as limited partnerships, and the typical investors are called as limited partners. Right, the typical investors are called as limited partners, whereas the management is called as the general partner. The management is a general partner, and for so these are more like they are passive. They don't take part in the day-to-day management and investment part, whereas the general partner provides some kind of active services for which a fund management fee is received. He is the this company is taking care of buying and selling of the securities and all, and along with that there is a performance based incentive, whereas uh, whereas this limited partners, they get for the capital whatever they have invested, they can get the returns on the capitals that they have invested. And here there is even a limitation on the number of investors. Generally, we see that this number does not cross 500. But even these few investors, they should be having sufficient wealth. They should not be bothered too much about the liquidity, because it might so happen that this investment may have to be locked out for a few period. So a person or an investor who is willing to withdraw the funds very soon may not be a fit into this kind of investment, and a sophistication in terms of investment is very much anticipated. So these kind of investors only can enter into the hedge fund, because it involves huge amount of investment and a kind of a waiting time before some kind of results are typically seen. And because of this reason, we say that the hedge funds are very less liquid, and some kind of buying and selling may create even more worsening situation. That's the reason some kind of restrictions definitely are set up as a part of the hedge fund provision. There is a lockup period, or and along with a notice period. Either of them or both of them can very well be there. Lockup period is you can't withdraw during a specific time period, whereas when I'm talking about a notice period, some number of days, let's say 1 month notice period. If it is 1 month notice period, then Only after a notice of 1 month is given regarding the redemption, the actual the redemption of the money does not happen. So the notice period, the lockup period, and in some cases there could be a penalty form of additional fee. Kind of a penalty which they call as additional fee for redemption. Even that is more or less to discourage the redemptions intermediately, and because every time some kind of redemption is happening, there is some amount of transaction cost built into it. So that the whatever is the penalty, kind of an additional fee that is charged, it's a kind of a compensation against the transaction cost. So the notice period, the penalty, all of them are targeted towards the discouraging of the redemption. And especially when we look at the redemption, they happen when the performance is poor. And and more redemptions happening when the performance is poor even creates a very bad performance, because sell-offs have to happen at not so attractive prices. Redemptions have to happen at not so attractive prices, which would even more uh, increase the chances of loss, which is adding up the overall bad performance of the system, adding up to additional risk coming up. So that's one more dimension to look at. Then the same hedge fund investment, see, normally it's wealthy investors with a sophistication of investment can very well get into it. But to make this hedge fund investment accessible to regular normal set of investors, there is one more instrument called fund of funds that is typically created. Here, it's like this entire fund, which may consist of normal, regular individual investors, they all pool together and enter as one investor into a hedge fund. So this is the company which is investing in a hedge fund. If not one hedge fund, it could very well invest in a diversified series of hedge funds following different kinds of strategies. So S1, S2, S3 strategies hedge funds it could invest in, which is resulting in some amount of diversification with respect to the hedge fund investment as well. But the only drawback is there is one charge that is done by the fund of funds manager, there is one fee that is charged by the corresponding hedge fund manager. So overall fee is going to be much higher in this process because of a two-layered structure, but overall it's giving you the diversified presence towards multiple hedge funds, right? Then we can look at the different strategies that are common in the hedge fund investment world. The classification of the different strategies is four-pronged. One, we talk about event-driven strategies. So more specific to a couple of events, any kind of corporate restructuring happening, any kind of merger or acquisition happening, these kind of strategies try to create some kind of profitable opportunities, especially with this corporate restructuring and M&A kind of events. We see something called as merger arbitrage. The arbitrage opportunity that can be created in case a merger is going to happen. In general, buy the target firm's shares once the merger announcement comes, buy the target firm's shares and sell the acquirer's firm shares. So doing a long and short position like this can create a kind of arbitrage opportunity in the future. Or probably we can talk about distressed securities or restructured securities. So even that is any company that is financially distressed, we say buy the firm which is undervalued In case, and it is in financial distress. In case your financial model can tell that it is having a better performance in case it is taken over by someone else, or in case it is restructured, but at the same time go short on the overvalued kind of securities. This is one more way the hedge funds try to create some kind of an arbitrage or some kind of profit opportunity. In some cases, they specialize in some special investments. Any corporate event which is more and more special, like any company which is issuing new stock or buyback of the securities, or if there is some kind of a spin-off that is happening in terms of the division, any company which is selling off its assets in a huge way, so some special kind of occasion they get into the buying and selling accordingly. So that's one more event driven strategy. And there is one strategy called become an activist shareholder strategy. Buy as many shares of the company as possible so that you can really influence the company in terms of increasing the overall value of the firm. So all these are the typical event-driven strategies that can be worked out by the hedge funds. We see some hedge funds that specialize in relative value kind of strategies. One is better compared to the other. So here it's always long and short kind of position. Generally, it is looked at like they try to use some kind of a mechanism to identify which something which is undervalued and they long on it, something which is overvalued and they short on it. So it's more of the identifying the pricing differences between the two securities, going long on the small priced ones, on the cheaper ones, and going short on the expensive one. So here a few strategies that generally get worked out are convertible arbitrage fixed income strategy, which means when a company has issued some kind of convertible securities, convertible bonds. So trying to find the mispricing between the convertible bond and the equity shares of that company. If there is a pricing mismatch, buy the cheaper, short the expensive one. Similarly, we are talking of asset backing the fixed income. Look at the pricing discrepancies that are coming with different MBS products, different ABS products, and based on that, go for buy on one, sell on the other. Similarly, look at the generalized fixed income products. Look at if there is any kind of pricing discrepancies between short-term bonds, long maturity bonds, for different kinds of bonds, for different kinds of maturities, different kinds of credit risk, different kinds of other characteristics. See, compare their pricings, go long on a cheaper one, go short on an expensive one. Then similarly look at the volatility differences between the two. So between the volatility, whatever that came out through a standardized model like Black-Scholes option pricing model versus whatever is the perceived volatility about that particular stock. Based on the difference, go for long position in one and short position in the other, or probably any of the combinations of any of these above strategies resulting in a multi-strategy kind of a mechanism. So you could very well see all these combinations go as a part of the relative strategies which can be implemented by the hedge fund managers. Similarly, there could be a third major line of strategies where the investment can be done, which can be treated as macro strategies, where the global economic environment is studied thoroughly, and based on that, try investing wherever the mispricings are coming up. Again, go with the long and short positions, but more and more equities of different countries, long on one country, short on the other country, fixed income, currency, commodity, almost any kind of asset, whichever is found to be mispriced based on the macroeconomic factors, probably long on the emerging markets and go short on the developed market. Some such kind of strategies can very well be planned out. And finally, it could be pure equity kind of a strategies. Long and short, again in the public market itself, either in the stock market or in the derivatives market. Probably sometimes I can try to make the position market neutral, making a long and short in such a way that the overall risk of the investment is almost zero. I can go with a technical analysis or a fundamental analysis, identify the overvalued security and short it, identify the undervalued security and long it. Right? The overall position is neutral. In the same, I could even think of beta neutral. Create the overall portfolio in such a way that the overall beta of the portfolio is zero, or probably identify fundamental growth kind of companies or fundamental value kind of company. So do a fundamental analysis, and based on the fundamental analysis, identify high growth companies and directly go for a buy in those kind of companies, or identify high valued companies. Identify the companies which have a better value, which means undervalued and they have a potential to perform in the future. So go long and invest in those kind of companies, or probably you can go with quantitative directional kind of a strategy, wherein we are talking about going long on those securities which are undervalued, along with going short on those securities which are overvalued. But try to use the quantitative methods or technical analysis to get into this kind of a mechanism. So all these kinds of strategies can quite comfortably be used by the hedge fund managers, and in some cases or in majority of the cases, any typical hedge fund initially specializes in one or two of these strategies, but as they move along they try to get a good hold on the different other strategies and try to get into a multi-strategy kind of fund management, right? So the probably more and more details can be looked at later, but just to understand what are the different kinds of trades that the hedge funds typically get into. Now, how do I evaluate? I mean, why do I need to really go for a hedge fund? First of all, as I discussed earlier, the returns on the hedge fund typically are better even compared to the global equities, especially when the global markets are down. Similarly, they are slightly lesser compared to the global equities when there is a boom in the market. So they act as proper portfolio diversification with respect to the global equity markets. Because when the equity market is in a boom, they are losing, but when the equity market has performed well, they have fallen. But even within them, different funds different funds, they have performed differently in different time periods. So while some of them are successful during the economic boom period, some of them are successful when there is a kind of a recession. But major thing that we really need to understand is correlation of the returns of this hedge fund returns versus the equity market returns. It is not perfect, it is much lesser than 1 and it is very, very close to 0, which is what is a very clear indicator that they are offering some kind of a diversification benefit. But during the latest 2008 financial crisis, it is very clearly observed that when the economy is not doing well, there is a correlation breakdown that has occurred. So, which means whatever the correlation that was lesser than 1, it has started going close to 1. So, when the equity market started falling, even the hedge fund market also started falling very badly. So, the diversification, whatever they have provided, is completely eroded here, right? Now, coming to the valuation aspect of the hedge funds, generally we see that the market value, especially if they are traded heavily, the market value of the hedge fund is typically the value. Otherwise, we can create a model where we can talk about the present value of the future cash flows. For non-traded kind of a security, I can create a kind of a model and use that model to estimate the price of it, right? And generally, I can very well go ahead with, from the trading perspective, I can go with the bid price, ask price, or the average of these two. But if they are more and more illiquid, whatever is the quoted price that we are looking at, it really needs to be adjusted for the kind of illiquidity that is present into it, and the size of it, because the higher is the size, the larger is the size, the lesser is the liquidity, and vice versa. And the kind of average trading volume per day. If volume is much lesser, probably illiquidity is going to be much higher. So some kind of adjustments and discountings for the same had to be done, and that is what in some cases we call it as a trading NAV. The trading NAV is the term which is the value of that particular fund after adjusting for all these kinds of illiquidities that are coming up. But of course, this is not the same as the typical NAV that is being used in the financial statement, which are typically used to assess the financial health of the company. Then, coming to from the investor's perspective, the kind of due diligence that has to be done in case of investment in a hedge fund. First of all, there should be a thorough investigation of the firm, because as we have said, the results that are typically presented, there could be lots of bias as a part of the result. There could be a bias that is more and more associated with survivorship, and there could be a backfilling kind of a bias, and at the same time there is a lack of transparency in the entire process. So whatever the trades that are done, whatever the transactions that are being done, the transparency lacks, and to a large extent they use the word that they are getting more and more into a proprietary kind of a trade, right? So the disclosures are very minimal, the regulations are not heavy. So in all these cases, it is very much essential that enough care needs to be taken while choosing an investment here. So the strategy, the investment strategy of the hedge fund of that particular hedge fund needs to be understood. The entire process need to be understood. Wherever possible, the historical performances, historical data really needs to be evaluated, and it has to be confirmed twice or thrice that these historical returns are not subjected to survivorship bias or backfilling kind of a bias. And if I really have to look at the competitive advantage of this fund, what is that particular strategy where this fund is really good at, right? How much is the experience of the fund managers? What is the longevity for since how long is this fund operating? What are the methods that they are using for some kind of calculations, returns, values, all that stuff? What is the total assets under the management of this particular firm? What is their style? What is the strategy that they typically follow? Who are the key people who are involved in it? What is the reputation of the particular firm? What are the growth plans? So a lot of these things, what is the risk management strategy that they are adopting? All these things, wherever applicable, wherever possible, needs to be gathered and evaluated. But of course, with respect to the hedge fund, the most challenging part is the persistence of returns. If I have generated the returns, where if this particular fund has generated a good positive return in the last year, does not necessarily mean that it is going to generate something in the next year, because a very simple thing, the strategy that it has adopted in the last year, the strategy has been successful and it has given, let's say, extraordinary result. Now, that strategy, first of all, might be comfortably copied by others, and or it may so happen that that strategy, whatever worked in the last year, may not work in the next year, which means whatever the profits or the returns that got generated in the last doesn't mean that I will generate similar, better than average kind of the returns in the future. So that's one reason, even if I have the historical data with me, there may not be much of a benefit. And a few more things relating to the aspects like reputation, the style, these are more and more theoretical in nature. Quantifying them is always a bigger stuff. So there needs to be a good amount of subjective judgment as well in terms of evaluating the various strategies from a hedge fund management's perspective. So this forms the initial base for understanding the hedge funds, just getting a broad high-level overview of these funds, which probably in detail you can start exploring more and more in case you are looking for a betterment in that particular space, right?